Hi everyone, welcome to Quantsapp and welcome back to yet another video. In today's video, we will understand about option strategy, which is iron fly option strategy, and I'll also tell you why I like this strategy a lot because of obvious reasons, which I'll tell you in the video. So let's start this video by understanding what is an iron fly and why we should exactly go ahead and why exactly we need some a strategy like iron fly. Okay, so first thing is options, they are affected by theta. We all know what is theta. Every passing day some premium is going to get decayed. How much, that is shown to us by theta, but there are some nuances of theta, there are some characteristics of theta. The most important characteristic of theta is such that if you just observe theta, so this is for 16th February expiry, so this weekly expiry. So where is theta? So the theta of 17,800 strike price call option is 14.24. Okay, and theta for 17,800 strike price put option is 14.32. Now what does it tell? It tells you that if you hold this option for tomorrow, the premium, this is the quantum of the premium that is going to get decayed. Now, if you just check this thing out, if I look out for 23rd February expiry, which is far away, it has a theta decay of 7.2. If I just move far away a bit more, which is still 2nd of March, then you see the theta decay, it keeps on decreasing, right? The theta, right? It is not killing the premium very fast. Okay, so now what's the purpose, right? What's the purpose of understanding this? Now, being an option trader, you know there exists an opportunity in this, right? In this characteristics, which is very easily accessible to everybody, and everybody knows it almost. Whoever trades in option, almost everybody knows it. But now the concept is that theta will decay very fast when we are very close to the expiry. Okay, so now how can we tackle this? Okay, how can we go ahead and monetize this thing? So one of the simplest strategy that will come to your mind is a short straddle. Okay, so what does a short straddle tell you? Short straddle tells you that you will go ahead and sell a call option, ATM. Okay, and you will sell a put option. Okay, again the same strike price call option and put option you will sell. Okay, so now what will happen is, when you constructed this strategy, what's happening in the back is that you're short on two options. Okay, 17,800 you're short on call and 17,800 you're short on put. Now let's say if the market remains exactly where it is. Okay, let's say this is how the market moves. One thing you know, that even if market remains like this, and if the market, even if it remains in that range, one thing which is going to happen is the theta, right? It is going to kill your premium. Now in this type of strategies, what will happen is it will kill your premium from the call side, as well as it will kill the premium on the put side. So this is theoretically one of the best theta decay strategy that one can implement. But the catch is why most of participants are most of the traders who avoid this strategy or modify this strategy is because of the risk exposure it has. Like it has an undefined loss on the both the sides. Let's say if the market goes to, let's say for an instance, okay, 17,500, okay, which is achievable, right? Market is right now at 17,780. If the market goes at 17,430, you will book a loss of 9,600, and same thing is on the upside as well. And there might be a scenario where the market might go to 17,500 or 400, and then again it may bounce back to 18,200. Okay, who knows, right? Because nobody knows till the situation happens. And it, let's say if there is a big gap up or a gap down risk, right? If there is a big gap up or gap down happening in the market, then what you'll do, you will not be even in a position to exit your trade or adjust that trade, because the stop losses won't work and nothing will work. Let's say if the market tomorrow opens straight away at 17,400, what you'll do? Nothing you'll be able to do. And that is the reason most of the traders and most of the sophisticated traders, they prefer hedging it, right? Specifically if you are uh, holding overnight, it is very much feasible to pay some premium, right? To pay some amount for the insurance that we are getting. Okay, so what we'll do is we will go ahead and let's say buy 18,000 strike price call option. So we will pay 17.8 rupees, almost 18 rupees we will pay for one side, and the other side also we will need to pay, right? So let's say 17,600 put strike, okay, is something what we will buy. Okay, so we paid, right? We paid, but the benefit is now if you see market going anywhere, right? So that is the aspect about the market. You don't know if it is going to remain in this range only, right? When you are writing a strategy. But now even if the market goes anywhere, you're limited, you're restricted, the loss is restricted to 3,580, right? 3,600, you can say it for simplicity. And what is the max profit? It is almost 6,000, right? So a good reward to risk is something what you're achieving as well. So this is iron fly strategy, and why I like it, almost the same dynamics like a straddle, but it will give everybody a sound sleep if you are deploying something like that, because even if market goes anywhere, you are not going to face an undefined loss because it is an hedged one. Number one. Number two, as it is an hedge strategy, so the system will know that it is an hedge, it is an opposite position or a hedge position being taken, so automatically the margin required will be reduced for this strategy versus a short straddle. So short straddle will require a big margin. This won't require a big margin because it is hedged. And the best time, right? So the best time to create such type of strategy is expiry, right? Expiry day is something what this strategy might work well. Reason being the theta decay being very, very fast. Okay. And yes, folks, that was it from my side for this video. Thank you so much for joining me up till here. Bye bye. Take care and happy trading and be a data driven trader. Thank you.